Welcome back to The Deep Dive. This is the show for you, the informed learner who needs to get right to the intelligence from the quarter's most pivotal earnings calls.
And today, we are doing a deep exploration of Playboy Incorporated, ticker PLBY. We've gone through all the intelligence from their Q3 2025 earnings call, which wrapped up after market close on November 12th.
And this felt like a real inflection point for the company. Management didn't just, report numbers. They really framed this quarter as the major milestone.
The one that finally validates their multi-year pivot.
Exactly. That whole pivot to an asset-light, high-margin brand licensing model. The tone was definitely optimistic. But let's look at the financials that actually drove that confidence.
Yeah, the headline numbers delivered a really significant and I think surprising upside. When we talk about core profitability, the numbers, well, they really speak for themselves.
Okay, so let's start with that top line surprise. Adjusted earnings per share, that's EPS, it came in at a positive 2 cents.
Which is a huge beat against the consensus estimate of a loss of 2 cents. They swung from an expected loss to an actual profit.
And critically, that profitability, it held up even when you account for everything.
Right. On a GAAP basis, that's generally accepted accounting principles, they hit breaking, 0.00.
Yeah.
Which, again, beats that 2 cent expected loss.
But the real moment to pause on, I think, is the net income milestone.
Oh, absolutely.
Yeah.
PLBY achieved a $0.5 million GAAP net profit. For anyone who's been watching this long turnaround, this is the first GAAP net income the company's posted since its IPO.
That's the foundational narrative shift right there.
It is.
That $500,000 is so much more than a number. It fundamentally changes the story from, let's say, a struggle for survival to, well, an operational success. Now, we should mention that revenue did come in at $29.0 million, which was a slight miss versus the $29.5 million consensus.
But that slight miss is, I think, largely just noise in the grand scheme of this strategy shift.
Right.
Management pointed out that if you normalize the revenue, adjust for those one-time strategic decisions.
It's like outsourcing their old e-commerce and the store closures back in Q3 2024.
Exactly. When you adjust for that, the underlying revenue growth was actually pretty robust at 4.2% year over year. The focus now is all on quality over quantity.
And you can see that quality reflected in the profitability, adjusted EBITDA.
Right. Earnings before interest, taxes, depreciation, and amortization. Basically, their operating cash flow.
That reached $4.1 million, which is just a massive turnaround from the negative $0.6 million they reported a year ago.
And to give you some context on just how powerful that was, if you strip out the $2.5 million in persistent litigation costs they had this quarter, adjusted EBITDA would have been $6.6 million.
Wow. So the core IP business is now just generating significant cash.
It is. It validates the entire premise of this asset-light shift.
So if the profitability metrics prove the turnaround is working, the next question is, how? We've got to look at the strategic pillars driving that leap in cash flow. And it all seems to start and end with monetizing their IP.
Absolutely. Licensing is the new core engine, and it was the major bright spot this quarter. Licensing revenue surged 61% year over year to $12.0 million.
61%.
And that jump was really driven by two things. First, a $5.0 million infusion from minimum guaranteed royalties from a key digital deal. And second, strong overages from existing licensees who were just blowing past their sales targets.
Which shows that once that framework is in place, the IP has serious earning power. And they're still building on that foundation, right? They signed 6 new licensing deals in Q3.
Pushing the year-to-date total to 14. And management specifically said they expect to sign even more deals in Q4 than they did in Q3, so that momentum is accelerating.
And it seems like that strategic approach even extends to tough markets like China.
Yeah, they did a smart restructuring of the China partnership. They moved from a really complex structure to a simple revenue share model with a Linfeng subsidiary. It just realigns the incentives and sets them up for a rebuild there without needing a ton of upfront capital.
Okay, so beyond that traditional licensing, the strategy seems to be about generating new IP for these high-margin verticals. Licensing, media experiences, and hospitality. Let's talk about the Great Playmate search, because this is a fascinating experiment.
It is. It's framed as capital-light IP creation, and it's pretty novel. It's basically a paid voting contest.
And the internal metrics were strong.
Very strong. It generated over 1 million votes from about 130,000 unique users. And management stressed that they did this with virtually zero customer acquisition cost. They genuinely think this can scale into a multi-million-dollar annual business.
It's a very modern way to generate content and cash at the same time. And what's really critical is the ecosystem effect, right? The IP they create feeds directly into the media vertical.
We saw that immediately. Deals with Propagate Content for a reality TV show and with Cooper Hefner for a feature film, Dead Actor Dark.
And both of those deals follow that same asset-light model.
Exactly. The licensing and upside participation model. Playboy contributes the brand and the IP, but their partners put up the capital and take on most of the production risk.
Okay, so moving to that third vertical, hospitality, we got an update on the Miami Beach Membership Club.
Again, the same structure. It's a licensing model. Playboy provides the brand IP. Partners provide the capital. They signed a non-binding term sheet with Miami investors for a $25 million investment into Playboy Hospitality.
But that's a longer-term play.
Very much so. Management was clear that we shouldn't expect any meaningful revenue from hospitality until probably 2027. This quarter was just about laying those foundational partnerships.
Okay, now here's where the strategy almost seems to contradict itself. While the focus is shifting away from heavy retail, their existing direct-to-consumer business, mostly Honey Birdette, showed incredible operational excellence.
It really did. The retail execution was just exceptional.
Yeah.
Comp store sales grew 22%. And maybe more importantly, full price sales were up 15%. This was not a promotional quarter.
So they drove margin expansion.
A lot of it. Honey Birdette's gross margin jumped 700 basis points. From 54% all the way to 61%. That's from a better product mix and just way fewer sales events.
So wait a minute. If the core story is all IP and asset light, why are they spending time exploring an external capital raise, specifically for Honey Birdette retail expansion? Doesn't that create a conflict in focus?
That is the exact tension you see in the call. Management is exploring raising capital at the Honey Birdette brand level.
Okay.
They want to accelerate its expansion into new markets, APAC, the Middle East, new U.S. flagships, because it's a successful business. But the key is, by raising capital at the brand level, they avoid diverting the parent company's cash away from the core Playboy content and licensing strategy.
Got it. So it protects the parent company's balance sheet.
Exactly. It lets a successful segment grow on its own dime.
That frames the dilemma perfectly. Okay, let's shift to the investor context, because balance sheet health is, it's everything in a turnaround story like this.
And the balance sheet looks significantly healthier. They ended Q3 with over $32 million in cash. And crucially, they amended their senior debt facility, extending the maturity out to May 2028.
So that takes a lot of the risk off the table. It buys them a huge runway to execute this strategy.
It does.
But we have to talk about the big one, that high-profile risk factor. The China arbitration. Playboy won an $81 million award against its former licensee.
Yes, and $81 million is a transformative number. But management was appropriately cautious. They kept saying that collection and enforcement in China are highly uncertain.
So they're viewing it as upside, not as part of the core plan.
Exactly. It's a high-risk, high-upside lottery ticket, not part of their base financial model.
Okay. And as for forward guidance, no hard numbers, but they expect continued adjusted EBITDA expansion and a robust Q4 for licensing.
The swing factors are pretty clear. Can they scale those paid voting contests? Can they maintain the HB momentum? And can they contain those legal costs that are still a drag on EBITDA?
And the market reaction really confirmed that investor focus is laser sharp on this narrative shift.
Oh, absolutely. The stock was up big the day after the print. And the options activity was just staggering. We're talking 19,707 bullish call options traded compared to an average of just 225 contracts.
That kind of surge, it just screams concentrated bullish speculation. Investors are buying the idea that this turnaround is the real deal.
And yet, despite that euphoria, the valuation still signals this is an early stage, maybe fragile turnaround. The stock is well off its lows, but with a high beta of about 2.5, the market is pricing in a lot of execution risk. Analyst targets are around $3 a share.
So there's significant upside if they can just stabilize and execute.
Right. Okay, let's transition now to our final segment. And as always, this is not financial advice, but we're putting on our most speculative hat to outline the outrageous but plausible trade idea based on the call.
And the thesis here relies entirely on that contingent recovery potential we just talked about. The market seems to be pricing PLBY as a successful operational turnaround that's finally cash flow positive.
What the market is not pricing in, because of all that uncertainty, is any recovery of that $81 million China arbitration award.
So given the high volatility, that insane options activity, and the stock still being well below that $3 target, there's a strategy here.
The idea is to gain high optionality on that one huge catalyst.
And we suggest considering the purchase of deep out-of-the-money, long-dated call options. Think strikes at $3 or even higher, with an expiration 12 or more months out. This is highly speculative, obviously, a high-risk strategy.
But the rationale is simple. This structure minimizes your capital exposure while capitalizing entirely on a huge, high multiple event.
So if the company successfully collects even a fraction of that $81 million,
Or if they drop some massive, transformative licensing deal tied to the new content strategy, the stock's narrative shifts overnight. It goes from turnaround survival to funded growth.
and that event could close the gap to those analyst targets almost instantly. It's huge leverage on a small principal.
Exactly.
So to sum up our deep dive, Q3 was, without a doubt, the inflection point PLBY needed. It was driven by licensing success and incredible discipline in Honey Birdette, and it really sets the foundation for their content-driven future.
But here's the final thought for you to mull over. Management has clearly signaled a need to delever and invest in core content. But they're also considering a major capital raise just for the Honey Birdette brand to speed up retail expansion. So the question is, how aggressively will they pursue that brand-level capital raise versus prioritizing investment in the core media business? And how does that choice affect the whole equity story going into 2026?
A tough strategic call for management to make. That's all the intelligence we have for this deep exploration. Thank you for diving in with us.